When Renee asked me to introduce the paper, she did mention that, well, why don't you say something about Mardi while you're at it? But I'm going to. I wrote mine because I don't want to leave out things, and I don't want to say it in a way that's totally confusing, and I probably would. Mardi was a presence. When she was around, whether it was at a seminar, a reception, or just about anywhere else, she made a difference, enlivening the world. I actually met Mardi in Dublin, of course, because she's Australian and I'm American, why not? I was visiting for a couple of weeks at Trinity College Dublin. Mardi was there one day, and Brian Lucy organized an impromptu one-day conference with Mardi, me, and some other people. Mardi presented on an informative paper on which I made a few comments. I presented my paper, and Mardi made perceptive, interesting comments. I said to myself, this is somebody I have to meet. And I did. I got to know her. We met, we kept in touch. She invited me to Cambridge while she was there, along with Tom Plavin, and I invited her to the Atlanta Fed several times. And it was very interesting. She left Cambridge and went to the University of Tasmania, and I was at a conference in Sydney. She arranged for me to visit her at Tasmania, and she and Renee arranged for me to visit at ANU. And this was a very nice thing to do, simply put. The point of this story actually is Mardi and I, with Tom Plavin, had started working on a paper to resolve a puzzling development concerning asset-backed securities, subprime mortgage-backed. I'd mentioned the problem, and she said, oh, I know a factor VAR we can use to deal with the issue given the particular kind of data we have. So while I was in Australia, and she and I and Renee and their families were there, Mardi was working on it on a little bar in the kitchen. She had her computer cranking out on this thing. This is at a beach. Which is quite remarkable. But she wasn't all work, though, by any means. Family actually mattered to her a lot. The story was telling for me. When she was leaving Cambridge, she could have gone back to ANU, and her alma mater, in a great department, actually. But Ross's father was going through difficult times. She was from Tasmania herself originally, and so her parents were there, so they wanted to be near the grandchildren, so she went back to Tasmania. I never heard her utter one word of regret or disappointment or anything like that. You know, she put family where it belonged. She enlivened the department, bringing in visitors such as Charles Goodhart, and it worked out very well. It's very sad that she's no longer with us. Very sad. Still, we do have memories and everything she did to remember her by, which is quite a lot. Thank you. So it's my honor to introduce Pierre Siklos, who's going to present the next paper.
Well, like everyone else, I'll thank especially, Renee and Tara and Graciela, but I think it was almost a year ago that Renee contacted me with this idea, and of course I was delighted to at that stage I wasn't sure whether I'd be presenting, but I said I would definitely participate, and of course I'm very happy to be here. Everything you've heard about Mardi, and you've now heard it from this morning on and through this afternoon, everything is true. Many of the things that you've all experienced, I've experienced as well. So I don't have too much to add, but I will add a few things, which is that one of the things that I'll talk about family because family was important to her, but also her students and her colleagues. So, you know, the traditional visit, you give a seminar and you might work with the person inviting you, but she insisted that, or she asked, but really she insisted that I give a lecture to her undergraduate students, and then she got one of her colleagues to ask me to give a lecture to more senior students, and then to meet every one of her colleagues. So she was interested not just in visitors for herself, but to improve the department and to improve, sort of broaden the outlook. The one thing I would say is when I think about Mardi, I think that if she weren't an economist, she'd be a really good sales representative or representative for Tasmania, because the one thing she made sure is that you saw a certain number of things, went to a certain number of restaurants and wineries in Tasmania. So she wasn't just interested in having you in the department. She was hoping that you would take the time and visit this beautiful island. And one thing I cannot remember is exactly how or where we met, but I know at some point it involved some emails, and then for many years, I assumed, at least I hope what she was doing is her due diligence to figure out whether this person was worthwhile talking to for some time. But eventually, what happened was that, as others have mentioned, this workshop was organized. Sadly, this was at a time when her back was giving her problems. She could not attend, and yet she still helped with the organization, even though the workshop ended up being held at my university. In any case, eventually in 2010, again, she invited me to go to Tasmania. That was the first time. And we arrived on a Monday morning. I remember this because she expected, of course, me to go straight to the department and start talking to her and her colleagues. But I asked whether I could be a little bit late, because this was the morning when, at least in Australia, early morning Australia, when the Canadian hockey team was playing the US for the gold medal in the 2010 Vancouver Olympics. And of course, she was quite happy to let me come in a bit later. And of course, being a Canadian, I had a big smile. So sorry to all the Americans here, but this was a very important moment for us. And then we basically just sat and talked from time to time, did the lunches, as many of you also mentioned, but there really wasn't any formal decision to say, okay, we should write a paper together. But over the years, that began to emerge. And when I went back in 2015, she finally said, okay, now we have this idea, we should sit down and work on it. And I'm the kind of person that sort of likes to digest the work for a while before I make it public. And she was a little bit less patient, and it's a good thing for me, really, and because it took a couple of years, but eventually we brought in another co-author, which was Vladimir, who's here, and eventually a working paper was produced. It hasn't yet been published, but Vladimir and I are determined to finish this joint work, and hopefully it'll see the light of day in some publication, and it deals with network analysis, which is not something I'm going to talk about today. But sadly, for not just for the profession, but certainly personally, the plan was to go and do some additional work, because as she was traveling the world, we Skyped from time to time, and we had a variety of ideas to extend the original work. And when something was not going right in the summer of that year, she could have said something like, I'm sorry, but I'm just going to be busy doing other things. Instead, she wrote a very nice email to me, and I think one or two other people, and I think, Jerry, you may have been in that email, saying, don't worry about your visit in 2019, everything will be fine, we'll go ahead with it. And sadly, of course, that wouldn't happen. And the other thing I remember, of course, and again, this echoes what Jerry was saying before, and not only showing us her selflessness, but one of the things she worried about during her sabbatical, which gave her great joy because Ross would go with her and travel to all these places, was the kids would be staying home. And I told her, look, at one point we left our kids too. We felt they were old enough and they would survive, and over time she got used to the idea, and she was glad to see that the kids did thrive. So it's really a tragedy that she's not here. And again, it's a wonderful idea to organize this meeting today. So I'm going to talk about something that is related to some of Mardi's work. Usually it's joined with someone else, so I'll bring that into the analysis a little bit later on. I'm going to take some liberties because assumptions are made as usual, and there's a limited amount of time to present. Hopefully the title says something about what I'm going to be talking about. And it really, the the origins of the idea come from a series of statements or comments that were made by former central bank governors, Mervyn King and Ben Bernanke, and then responses to some of these comments by well-known finance writers, Martin Wolf, and then at the time, Willem Boyder was not an academic. He was, I think, by that time at Citigroup, about basically the impact of global shocks and how we should interpret them. And of course, as you can tell, and I'm not going to read through this, there are a number of issues going on in the minds of these policymakers. The role of commodity prices, which I'll underemphasize here, but the issue of simply global shocks, how we define them, how large they are, whether they impact advanced economies differently than emerging market economies. And so the work I'm going to do, which is empirical, is situated around these themes. Of course, they're not the only ones to have talked about this. More recently, Mark Carney, who's soon to be the former governor of the Bank of England, also was a little bit more careful in his statement, as he typically is, but he talked about the role of globalization, and there are different ways of thinking about or defining globalization. I won't get into that. And since the time that Bernanke and others talked about these things, of course, the issue of how certain commodity prices in particular are set, which is largely in US dollars, has also sort of entered the picture. And again, that indirectly plays a role, but not in the presentation I'm going to talk about today. So again, this issue has not disappeared for over a decade, and I'm sure after you see the results here, there'll be still much more to talk about, including actually, interestingly enough, although I won't talk about it here, the issue of loadings, because there will be a factor model here that plays a role. And I do talk about the loadings, but I won't talk about them here. And I'm sure that some of the remarks that were made by Hashem Pesar before the break will play a role in some future work. So here's sort of one picture that some observers will show to make the case that there's some kind of link between globalization, and there are different ways of defining it. This comes from an institute in Switzerland that monitors globalization and defines it as a combination of a whole bunch of variables. How both finance and trade globalization, we may disagree about whether this is an accurate way of measuring it, how it's risen over time. There's a little bit of a dip around the time of the great financial crisis or global financial crisis. But then it resumes a little bit, it flattens. Whereas inflation in advanced economies, and I'll briefly talk about what I mean by advanced and emerging market economies shortly, overall shows a downward trend. It emerges more clearly in emerging markets a little bit in the late 1990s or early 2000s. So of course, a whole slew of papers have been written since about the source of this kind of relationship, and whether it's the policy regime, whether it's commodity prices, whether it's the improvements, particularly in emerging markets, of central bank autonomy, improvements globally in institutional factors like transparency. Again, these play a role in the background in the paper, but I don't want to highlight this. I want to highlight something else. And then, of course, the role of the exchange rate regime, whether it's the way it's measured by the researchers like Carmen Reinhardt and her co-authors, or other ways of evaluating the degree of flexibility in exchange rate regimes. All these issues have been brought up, and I think part of the reason why there's continued interest in this topic is because two of the most important central banks in the world, the Fed and the ECB, are undergoing reviews of their policy strategy, in part because, as you perhaps have noticed from the previous slide, inflation rates remain low, and in spite of the attempts by central banks to raise inflation rates to close to some target, they haven't quite yet succeeded. So all these things, of course, play a role. So I'm going to try to sort of downplay any notation and focus mostly on some of the descriptive results. I won't talk about all the results. I'll try to focus, cherry pick on a few that I think are interesting, and I hope you find them interesting too. So I'm going to look at a total of 29 economies. I won't explain why these 29. I could have picked a much larger number. Partly it's data related. Partly it's because this is a piece that's a companion piece to some work I've done both on the longer run data And with this kind of data, with Michael Bordeaux, where we look at policy regimes and links with inflation. I'm going to look at a variety of time series evidence. I'm going to look at 3 types of evidence to see what we can tease out from the data. I'm going to, a little bit, as I said, take some liberties. The results I'm going to emphasize here are going to focus on a level of aggregation. Not because individual country estimates are unimportant, it's just simpler to present at an aggregate level what results I find. Clearly, some of the results will be affected by this level of aggregation. I'm quite aware of that. If you want a little bit more evidence at a more disaggregated level, including a broader description of things like factor loadings, the paper that Mike and I wrote for a conference, the Central Bank of Chile last year, which is forthcoming sometime this year, will provide a few of the additional details. So in case I run out of time, a couple of bottom lines, which is that global inflation, which is perhaps not surprising, matters, but there is the impact in advanced versus emerging market economies is more heterogeneous than sort of narratives that we sometimes see in the literature might lead us to believe. Of the 12 advanced economies, these are the usual suspects, so it'll include the G7 and the G8 and a few of the other advanced economies that are listed as such by the IMF. And the 17 emerging market economies also include, obviously it's a much smaller number relative to the potential universe of emerging market economies, but these are the ones for which we have a long enough time series, and the quality and the consistency of the time series is such that we're comfortable that this is the right, maybe not the right number, but a good number to look at. So they include a mix of emerging market economies that target inflation, others that don't target inflation. Many in the advanced world, of course, do target inflation. Sometimes it's more formal, like in Canada. Sometimes it's much more informal, like in the US or the Eurozone. And the other point I'm going to try to emphasize, which is also not unrelated to some of the applications that we saw this morning, is that it matters that you look beyond just the mean or even the median of inflation performance, that you look at let's say, the better performers and the poorer performers. And one way in which I'm going to tease that out of the data is to show you some quantile regression results later on if I have the chance. All right, so I'm not going to give you a long literature review. There's some people in this room, like Anyan as well, who have contributed a lot to this. This just gives you an idea. What I want to emphasize here is that this is an old idea, and particularly coming from a small open economy like Canada, as is Australia, this is an issue, the role of global shocks that's preoccupied us for decades. It's more recent in the broader literature, but in small open economies, it's always been an issue. The earliest one I can see in Canada is a paper by Wilfrid in the Canadian Journal back in the 1970s when we talked about open economy Phillips curves, which are now discussed quite widely. And Mardi, and this is when I was thinking back of how we met and how we start to exchange correspondence, I didn't realize, but she cited an early paper of mine in this area and a paper that she wrote with, I believe it was a former student of hers back, and it was published in 2000. Now, since then, of course, since way later, China began to emerge as the source of a global factor. And there's a large literature that looks at the contribution of China to global inflation. Much of this literature focuses, and this also plays a role in explaining the number of emerging market and advanced economies, focuses on observed inflation. And one thing I want to introduce, well, maybe introduce is a strong word, but bring into the analysis is the role of expected or forecasted inflation. And that also limits the amount of data that you can compile, because for many emerging markets, forecasts of inflation or real GDP growth are much more recent. They're sometimes in the mid-2000s. So that also played a role in the analysis in limiting the number of variables. So I've talked about the data. So the only thing I'll say about the factor model here is that, and this is where the aggregation comes in, and it's done in part just to tell the story in a simple fashion, which is to look at advanced economies separately from emerging market economies and all economies together to extract global inflation in the usual fashion. I won't discuss here the number of factors. I do discuss it in the paper. The only small twist, and this is where the link to factor loadings in part comes in, is that I'm interested in the evolution of the factors that the performance of factors over time. There are different ways of doing this. Again, I'll skip the details. I'll show you one illustration of the results. The results seem to be fairly robust, but I'm sure there may be other views. But the other thing I was interested in is not just extracting the factor in the usual way, but as I said earlier, extracting these factors by looking at, imagine that these countries in these groups have peers that they look at, say the US, for example, or the ECB. And among emerging markets, some of the peers might be the inflation targeting emerging market economies versus those that don't target inflation. So I'm interested really in the distribution of these global factors over time as well. So just to give you, in each case, I'm just going to highlight 2 or 3 results. I'm not going to go through all the details. The first one is not terribly surprising, which is that when you look at average inflation rates, advanced economies outperform emerging market economies, meaning that on average they have lower inflation rates. One thing that's less emphasized in the literature is that there are some interesting differences in overall performance when you compare observed inflation to expected inflation. I'll talk a little bit in a moment about how expected inflation is calculated. But in particular, it's the volatility. If you just look at the standard deviations of forecasted inflation versus observed inflation, they tend to be smaller. The former, as you can see, tends to be smaller than the latter, and that's true for most of these economies. And you have the 2-digit or the 2-letter ISO code that identifies the economies in this sample. And lastly, again, the point that I raised earlier, which is the focus on the mean, which is the common way of dealing with these problems, overlooks some interesting variations over time and across countries between the best performers and the worst performers. I'm going to try to extract some information that will give me some idea of how these different types of performances in terms of inflation matter, not just in terms of observed inflation, but also expected inflation. Now, when it comes to expected inflation, when you look at advanced economies, as someone who's worked on this quite a lot, in particular working the area of forecast disagreement, you have a large number of potential forecasts you can draw on. When it comes to emerging markets, it's a bit more difficult. For the purposes of this analysis, so I compare like with like, I'm going to use data from the consensus economics and the World Economic Outlook, because we have a consistent data set across these countries and over time. I wish I had more, because I think there's some value in looking at a variety of inflation forecasts, not just a single one, but there are some limitations here, which I can't help. All right, so just to give you an idea what some of these global factors might look like. So you can see the sample. I'm only showing you from the late 1990s to early 2018. And again, I'm going to highlight just a few of the stylized facts here. So you have 3 sets of lines shown. One is what would happen if you looked at all the economies together and extracted the global factor in the standard fashion. One, what you would get if you extracted again in the standard fashion based on observed inflation. So one is observed inflation, that's O. One is inflation for advanced economies, that's in the top chart. And then the last one is what happens if you extract a global factor just from the inflation forecast. And for the inflation forecast, I look at the mean and the median of those 2 forecasts. And the results don't seem to change very much whether you use the mean or the median. And what you see is, of course, there are some broad similarities, although there's more heterogeneity in what you get when you go into the early 2000s, particularly when you aggregate for all the economies as opposed to looking at separately the advanced from the emerging market economies. Here, just for the sake of time, the top chart, or the top plot shows advanced economies. The bottom one shows emerging market economies. And the downward trend, except interrupted around the time of the financial crisis, is quite evident in the case of emerging market economies. So there's there's basically global improvement in overall inflation performance, no matter how you cut it. There's an interruption around the time of the financial crisis. The interruption looks a little bit different in advanced economies versus emerging market economies. And so I recognize that there's likely to be sensitivity to the results depending on whether the global factor is limited to a group of economies, all the economies in the analysis, and so on. So I won't show you all the various robustness analyses, but these were conducted. All right, so the empirical evidence, again, I'm going to show you just cherry pick some of the results, is going to be broken up into three parts. The first part is something that perhaps to me is a little bit of a surprise, but in this literature, there's a tendency to estimate global factors in this fashion, for example, embedded into a model. It could be a VAR or some other kind of perhaps a single equation model, and then run the analysis and ask, well, did China play a big role? Do global factors more generally play a big role in China, and so on and so forth? There's a little bit less work, or a lot less work done on whether there are structural breaks in these types of relationships. So in the first instance, I'm going to take a garden variety version of, well, you can call it an expectations augmented type of Phillips curve. That wasn't my original intention, but basically I'm going to look at inflation as a function of both the past history of inflation and expected inflation, as well as both the expected real GDP growth and the past history of real GDP growth. And I've played around with things like the lags and so on, and other variables. So here I show the real exchange rate, commodity prices, because without showing you the details, commodity prices do play a role in the inflation story. And then global inflation defined in a number of different ways, and I've alluded to earlier, depending on emerging markets or not, or advanced economies, and I have to hurry up. So the point here was to do two things. First, what would happen if you estimated these breaks for individual economies? What would the results show? And then secondly, what would the breaks look like if you estimated them in a panel setting? And look at the comparison between the two. Now, in addition, I was interested not just in the actual point estimate of the location of the break, but I recognize that there is a confidence interval around these things. And I want to see to what extent these kinds of breaks that you estimate look like the breaks that some people have remarked in sort of narrative descriptions of Phillips curves, how close they are, whether they match or not. So I want to look at this, and I'm not going to go through the global financial crisis, perhaps unsurprisingly, comes out at the top, but less obvious is that the early 2000s plays a big role in emerging markets, and that's around the time when many of these emerging markets, whether it's through the adoption of an formal inflation target, or simply a decision to go along with their peers and try to moderate inflation rates, start to implement policies, monetary policies, to achieve those outcomes. So those are the two breaks that dominate, and that seem to be the closest to the ones that you find when you look at more narrative descriptions of these breaks. The second thing I was interested in is whether globalization, as many have argued, actually resulted in a lowering of average inflation rates. And the bottom line, the impact is negative, but it's quite sensitive. It's much more heterogeneous than we might otherwise believe, depending on whether you focus on advanced economies only, emerging market economies, both economies put together, whether you average across the individual economies or whether you estimate them as an average in the cross-section. The answer is that it's negative, but the size of the coefficient, those are p-values in parentheses, is going to be quite heterogeneous. So I'll skip the summary here. The second part, and that's the other part that is inspired by Mardi's work, and unfortunately, I suppose, when we do work, whether it's in my case, co-integration many years ago, sometimes these things fall out of fashion. The good news is that the work on contagion, or sometimes people refer to it as spillovers, has not yet fallen out of fashion. In fact, Roberto Rigobon plays, of course, an important role in this literature, has revived the issue and pointed out the similarities or differences across different definitions of contagion and spillover, and I won't go through the detail, but basically I asked myself, well, what are the spillover effects or the contagion effects when it comes to inflation. And there's lots of things here, but the main takeaway here is that the extent of the spillover effects or contagion is a function of whether you look at emerging market economies separately from advanced economies, and more importantly, whether you look at the best performers versus the poorest performers in terms of inflation performance over time. So looking at the distribution, not just the mean, whether it's for an individual economy or across economies, is going to be important. And the last part is basically just to use a more or less conventional type of VAR, but in this case, I'm going to use a local set of local projections in the quantile setting to look, in fact, at in this particular case, and that's what I'll conclude with because I'm going to be out of time, is to look at the link here. I was interested in the link between shocks to expected inflation and observed inflation and how they are linked to each other. Now, typically, very often in sort of conventional local projection models, you have a lot of variability in the estimates of the impulse responses. Here, except for the top left-hand side, which shows the response of observed inflation to expected inflation or forecasted inflation, I suspect part of the reason I'm getting this is because of the aggregation. If you look at individual level economies, you'd probably be best off doing some smoothing to get some more reliable results. And those are the confidence intervals. And just by way of comparison, so I don't show too many lines, I show what the impulse responses would look like with a conventional Cholesky decomposition. And basically, the main message here, as you can tell from the left-hand side, is that expectations, not surprisingly, react with a lag, but more importantly, inflation is less responsive, or is not responsive to the global element in inflation forecast, but is more responsive to the global element in observed inflation. I don't have a complete explanation for this. It's still something I'm looking at. And there are other results here, such as, and you can see that from the bottom left-hand side, which shows in that particular case the response not just to inflation, but in this case, real GDP growth or observed real GDP growth to inflation forecasts. And you can see that the link is positive and quite significant. Now, in this case, these are the quantile results. Here, I'm not going to show you the confidence intervals, but I want to show you the results, the impulse responses at different quantiles, but they're all statistically significant. So here again, the message is the same as before. Particularly if you look at the bottom right-hand side chart, you can see that there's quite a difference between the impulse responses at the various quantiles they look like. And here I'm going to look at, here it's 0.1, 0.25, 0.75, 0.9. All the others were calculated, but just to give you an idea, and you can see that there is a difference between the poorer performers and those, and between advanced and emerging market economies and the better performers. If you compare the two right-hand side impulse responses, and this is the response to expected inflation to a shock in observed inflation, you can see that the responses are different in the case of poorer performers, but they're more homogeneous in the case of the better performers. And I think I've run out of time, so I'll stop here.
So you got about 10 minutes for questions. You did great.
We'll see. People are tired.
What the question I often, to estimate these global factors, you need n large enough. I mean, I know you want to have heterogeneity, so I think a more reasonable framework would be to have, say, if you want to go around the quantile regression with unobserved common factors, rather than splitting the n. Because obviously you can keep splitting the groups, but then you end up having subgroups, as you probably agree, that they're not enough there to be able to identify the factors. I've actually, just to advertise, we have a paper coming out, Journal Applied Econometrics, which done by some of my younger colleagues who work with the Chronoker. I mean, I think that that could be a possible approach. The second point, which is also relevant to some of the other papers, is that when you do this projection approach, remember the projection approach can be justified because of linearity of underlying VAR model.
Right.
Right. As it's been recently also pointed out by Watson, one of his colleagues, junior colleagues, they have a paper,
Right.
which actually, if you have a linear VAR, whether you do projection or you iterate the VAR, you should get same
That's right.
answer. In fact, the linear VAR is more efficient
Right.
if the model is correctly specified, right?
Yeah.
So then the point I was making that I thought because you raised it, but when you do quantile, what is the underlying model that you dynamically you could iterate forward? So I think the application of projection to quantile regression has to be made justified, because I don't think anybody does. They say, "Oh, I do it."
Yeah. I suppose the paper used the same justification that Steve Cicchetti originally did when he originally sort of introduced this. And he also introduced this to sort of a macro framework. But you're right, it's basically a feeling of, or an impression, an intuition about what the data might say as opposed to concrete sort of theoretical model. The only other thing I would add, and this is basic, I suppose this comes from more stylized facts than theory, is that there are clearly, as countries have gained more experience with formal inflation targeting versus not targeting inflation, there is this interest in whether the inflation targeting central banks become better performers, so to speak, in the language I use, versus others. And that's, at this stage, that's about it. But clearly, a more formal justification would be desirable, I agree.
So I had one question and one comment. The question was, unless I missed it, I wasn't clear precisely what inflation measure you were using. Was it an annual inflation?
No, it's quarterly.
It's quarterly.
It's a CPI. It's observed CPI in all these economies, yeah.
Okay,
Quarterly.
seasonally adjusted?
Yes. Well, it comes seasonally adjusted, so you could try to get unadjusted data, but you will not find unadjusted data for all these economies.
Yeah. Some countries don't. The UK, for example,
Right.
doesn't officially see CPI inflation, so it's seasonally
No.
unadjusted, and it is seasonal.
Right.
So it peaks each year after the budget in the second quarter. And so there is a seasonal component. And in the case of, and I think many European countries, or not all European countries, publish seasonally adjusted CPI. And the nature of the seasonality has changed because of what's included in the basket, which in particular, until about 2000, that they didn't include sales. So when stores or whatever had sales on, they were excluded, and then it was ruled they had to be included, and that then introduced a new seasonality into the series that wasn't there previously.
Well, certainly you and I know something about seasonality, but...
We do indeed. And I know
most people think it's a really boring subject, so I've stopped trying.
Unfortunately, they do, don't they?
Yeah, they do, but so I believe, and I have to double check, but when, for example, the IMF and the International Financial Statistics report the data, I think they seasonally adjust the data.
Maybe they seasonally
Yeah,
adjust.
certainly, yeah.
It might be interesting to check. Because
You're right, yeah.
the ONS doesn't seasonally adjust in the UK, and it always gets reported in the UK inflation for last month, but it wasn't inflation of last month. It was
And of course,
over a year to last month.
In these economies, the inflation rate that the policy authorities examined is not necessarily the same one that I'm using. So
Yes.
in the US, it would be personal consumption expenditures.
Yeah.
The ECB is the harmonized index and so on. So yeah, these are additional data complicating factors that introduce noise at the very least. Yeah.
And just to say a comment that I don't know if you're familiar. I've got a paper with co-authors about structural breaks in inflation. JEDC, I think it was 2017, maybe.
I missed that. I'll have to check, but I will.
Right. So, but what we tried to disentangle what was changing when there were structural breaks. You only looked at observed inflation.
Right.
What was changing, and was it dynamics? Was it but we weren't looking at factors,
Right.
looking at individual countries, but found a a coincidence, and then what we concluded changed was that the mean inflation came down in a number of advanced economies, in particular around the same time. I think that echoes.
Yes. Well, I didn't get a chance to emphasize it enough, but I was interested in not just observed inflation, but really expected or forecasted inflation. I think it is worth looking at the breaks in the two theories.
I agree entirely. Yeah.
Thank you. So when we think about this global factor explaining inflation, what we found out, if you look at the data from the 70s, in fact, you have this very large global factor in the 70s. Mm-hmm. Even larger than the global factor, inflation variation. It's a different era. One is, different. One is driven by a certain shock, but the ultimate impact, if you just simply focus on the time series, same. You might interpret it as, there is this role for some global factor, of course, in the 70s, that was oil price shock. And then I was thinking, you looked at the issue, and there are a lot of questions about inflation data. The World Bank will soon release a new database with a very rich inflation series, including disaggregated series.
I don't disagree about the comment you made about 1970s. I mean, one way I cut corners, wasn't here said so explicitly, is that you have some large emerging market economies that go through hyperinflation, like Brazil and Poland and in Europe and Israel. And I guess I just wanted to avoid the complications that arise because of that problem with the data. So I'm not making a statement that what happened since the late 1990s until more recently describes all of history of inflation. So, but I'm interested in finding out about the inflation data. I appreciate knowing that. I think Tara wants me.
Yeah, no, actually, I did want to jump in quickly on the conversation you were having with Denise, just because I thought that was really interesting for thinking about how the interaction between which measure the monetary authority is looking at and how that might actually play a role in some of your results, I think is a really interesting point. Yeah. But I also want to move on to the next session because we have to jump into the next one. So thank you very much.